expected path here, driven by the interest payments from the pandemic debt, which was a huge increase in debt. Now, this debt keeps compounding, obviously, because you're adding debts on top of debts on top of debts on top of interest payments. So I don't expect it to play out fully like this, but we should expect a big increase in liquidity going forwards, and that's crucial to the theory. You see, look at that trend of total liquidity. Think of it again in a different world. That is the ongoing trend of debasement of currencies. That, when you debase the currency, gives you an optical illusion that asset prices are rising. So this chart of the NASDAQ versus the total liquidity index shows how correlated they are. It's actually 97.5% correlation. Now, the NASDAQ actually outperforms this because it's a secular trend. But this debasement explains almost all of the movements of all assets over time, which is why everything is so correlated. Yes, some things lead, some things lag, but this is the crucial chart to understand. The answer to the demographics is more debt. The demographics is causing a slower economy. And to get over that, they issue more liquidity, debase the currency to pay for it. That makes asset prices rise. This is the everything code, and it's really important. You see, most people don't understand that this is the global liquidity index from all the major central banks. It's growing at an 8% annualized rate. Now, once you add in global inflation, and let's call global inflation about 4%, you've got a 12% hurdle rate for any investment. Now, that's pretty staggering, because if you think about the S&P 500, it does about 12% a year. So basically, you're not getting ahead by doing it. Your savings aren't accruing future value, just present value. This 12% hurdle rate is a huge problem for people if you don't understand it. You are basically getting poorer if you don't hit your 12%. So if you're just investing in bonds and think it's a good idea to get the 5% interest, well, your future self is getting poorer. So when we look at global equities versus the total liquidity index, we've seen that since 2008, from the crisis when they started printing money, it collapsed, but then it's been sideways ever since. So they've basically offset the balance sheet but done no better. And if we took it from 2007, before the big printing started, it's actually lost 2.54% a year versus the debasement. So you've been poorer for owning equities, generalized global equities, than the debasement itself. So that's cost you money. When we talk about crypto, I use the charts of Bitcoin here because Bitcoin has the longest price history. It too is stunningly correlated with global liquidity. You see, Bitcoin has an 87.5% correlation, not as high as the NASDAQ, because, as you can see, it's the periods of outperformance that lowers that correlation. When we start to get, full kind of mania, crypto mania cycles that you get in this exponential asset, because it is a much more exponential curve, because it's driven by tech adoption. And we'll come on to that in a second as well. But you can see that liquidity is the driver of Bitcoin plus technology. But when I look at Bitcoin versus global liquidity, it's outperforming the debasement by 105% a year. I mean, that's a staggering difference versus global equities, which are not doing anything at all and are probably negative. That's a huge, huge difference in your future purchasing power, which is why this is such an important asset. And again, I'll come on to more of this in a bit. But we've ascertained that technology stocks are in a secular bull market. They're 97.5% correlated, but they've been rising very well over time. However, when you look at NASDAQ versus Bitcoin, this is a crucial chart. So NASDAQ is the best performing equity market in the world, essentially. But when you look at it versus Bitcoin, Since this period of debasement, NASDAQ has underperformed by 99.93%. Just wrap your head around that. And it doesn't stop. It's underperforming by 45% a year. And as you can see, we're going to break to new lows, and this chart will just continue. As Bitcoin and crypto eat the world, it's something I call the supermassive black hole. I look at Bitcoin charts versus every asset, and they're all the same. They're all down 99.9 something percent. And then I look at relative values between Bitcoin and Ethereum, or Bitcoin and Solana, and that's where you get to choose what you think the fastest horse is. And that's why I chose Solana this cycle. But basically, crypto is the supermassive black hole, the asset that appreciates faster than anything else, and on a risk-adjusted basis too. So what's driving this? Well, what's driving this is obviously the debasement of currency, but why the other 105% excess returns versus that? Well, it's this chart. This is starting the internet at 5 million IP users and crypto at 5 million wallets, active wallets. So yes, I know that neither of them are perfect measures, but I'm not looking for perfection. I'm looking for understanding.